Two twin brothers, same income, same age, same $250,000 death benefit, two completely different policies, two completely different philosophies about what insurance is even supposed to do for a person. This is a scoreboard, checked every 5 years for 3 decades, run honestly in both directions instead of cherry-picked toward whichever answer makes a better headline. The twist at the final checkpoint is not the twist you're expecting, even if you already think you know which policy wins. Hold that confidence loosely. We're about to test it for real, with real numbers, against a real claim. Dean and Walt are 25, identical twins, 6 minutes apart at birth, and, for most of their lives, financially indistinguishable. Both make $58,000 a year. Both just got married within 4 months of each other. Both sit down separately to buy life insurance for the first time, and that's where the identical part of this story ends. Dean buys whole life. Their uncle, who's sold insurance for 22 years, walks him through a binder at a family dinner. Guaranteed death benefit, guaranteed cash value growth, a policy that never expires and pays you back. Dean signs for $300 a month, a $250,000 death benefit, locked in for life. Walt, sitting at the same dinner, asks a question their uncle doesn't love answering directly. What would the same death benefit cost as a simple 20-year term policy instead? The answer comes back at $42 a month. Walt buys the term policy and, on a co-worker's advice, opens a brokerage account with the $258 a month difference, set to auto-invest into a low-cost S&P 500 index fund every payday without exception. Here's the math the insurance industry hopes you never run, and it starts before either brother gets to year 1. Of Dean's first-year premium, $300 a month, $3,600 for the year, his uncle's agency keeps roughly 55 to 90% as first-year commission, a standard structure across the whole life industry, meaning somewhere between $2,000 and $3,200 of Dean's first year of payments never reaches his cash value at all. It funds the sales process itself. Walt's term policy carries a commission too, but on a $42 a month premium, the dollar amount is almost too small to matter, which is exactly why almost nobody's uncle has ever sat a 25-year-old down with a binder to sell them term. Scoreboard, Year 1. Dean's policy shows $0 in cash value on the official illustration, entirely normal, entirely disclosed in the fine print, and entirely the reason whole life feels like a bad deal to almost everyone who cancels in the first 3 years, which is most people who buy it. Walt's brokerage account, after 12 months of $258 contributions through ordinary market noise, sits at $3,140. Neither number tells you much yet. Keep watching. Scoreboard, Year 5. Dean's policy has built $9,800 in cash value, exactly the number on the illustration their uncle showed him, dollar for dollar. He feels vindicated. The binder predicted this number, and the number arrived right on schedule. Walt's brokerage account, after 5 years of contributing $258 a month into an index fund through one of the more volatile stretches the market's had in a decade, sits at $19,400. Dean is already a full $9,600 behind his twin brother, and he doesn't know it yet, because nobody's actually comparing the two accounts side by side. That's about to become the most important habit in this entire story. Here's the hook worth sitting with at Year 5. Dean's policy is performing exactly as promised. That's the part almost nobody tells you about whole life. It isn't usually a scam in the sense of breaking its own promises. The guarantee genuinely guarantees. The problem was never that the policy lied. The problem is what guaranteed actually costs you, measured against the version of the same protection that doesn't carry the guarantee at all. Scoreboard, Year 10. Dean's cash value has grown to $23,100, still tracking the illustration almost exactly. Walt's index fund, after a full decade of $258 monthly contributions through one significant downturn and one strong recovery, has grown to $54,700. The gap is now $31,600, more than a year of either brother's salary, and Walt hasn't done anything more sophisticated than not touching the account and not skipping a single contribution. Dean, for the first time, asks to see Walt's statement at a family barbecue. He goes quiet for a long moment looking at it, then calls his uncle that same week, more confused than angry. His uncle's answer is the same answer the whole life industry has given for a century, and it isn't technically false. Your account can never lose value in a downturn. His can. It's true. It's also true that Walt's account has gained $31,600 more than Dean's specifically, because it was exposed to the downturns Dean's policy was designed to never feel, and that the insurance company invests Dean's premiums in very similar markets to the ones Walt is in, just keeps the upside for itself while guaranteeing Dean only the floor. Dean doesn't cancel the policy that week. He sits with the number for a long time. He just goes quiet. Scoreboard, year 15. And this is where the story almost takes a turn neither twin sees coming. Dean's daughter is diagnosed with a treatable but expensive childhood illness, and the family needs $11,000 over 8 months that isn't sitting anywhere easy to reach. Dean calls the insurance company about borrowing against his policy's cash value, now at $41,200, and discovers two things in the same phone call. Yes, he can borrow against it, and the loan accrues interest, currently 6%, that he'll owe on top of repaying the principal, or the loan balance will simply reduce his death benefit permanently if he never pays it back. He takes the loan anyway because the money is genuinely there, and the alternative is worse. Walt, watching this play out from the next state over, realizes his brother's guaranteed account isn't actually a piggy bank he can raid for free. Borrowing from yourself inside a whole life policy is still borrowing, with real interest, from a company that's also still collecting your $300 a month the entire time you owe it. Walt's own wife asks him the obvious question that week: if something happened to your daughter, could you get to your money as fast as Dean got to his? Walt runs the numbers honestly instead of defensively, the way he's tried to run every number in this story. Selling shares in a taxable brokerage account takes 2 to 3 business days to settle, no loan paperwork, no interest charged on your own money, no permanent reduction to anything, just a sale, a quick tax calculation on whatever gains you're realizing, and the cash lands in his account almost as fast as Dean's loan did, with no debt attached to it afterward at all. The accessibility argument, it turns out, favors Walt's account just as much as Dean's once you actually compare the mechanics instead of assuming a policy loan sounds safer than a stock sale because of the word loan attached to one of them. Walt's wife asks one more question that night, a fair one. What happens if Walt dies first, before the account is big enough to matter? That's the entire reason the $42 a month term policy exists sitting underneath the whole strategy the entire time. It isn't an alternative to having insurance. It's a cheaper, time-limited version of the exact same protection, running in parallel with the investing instead of it. The strategy was never term instead of life insurance. It was term as the life insurance, with the gap invested rather than handed to an insurer to invest on his behalf and return to him at a guaranteed, heavily discounted rate. Scoreboard, year 20, the point at which Walt's original term policy is scheduled to expire. His daughter's illness resolved years earlier. The loan got repaid in 18 months at a cost of about $1,100 in interest, money neither twin loves having spent, but neither considers catastrophic. Walt's index fund, after 20 years of consistent contributions, has grown to $187,000. Dean's cash value sits at $61,400, technically ahead of the loan balance, but a small fraction of his brother's number. Walt now faces his own decision. His $42 a month term policy is expiring, and a new 20-year term at $45 would cost significantly more, since premiums climb sharply with age. He runs the numbers and realizes something his uncle never mentioned at that original dinner. By year 20, his $187,000 investment account is large enough that he no longer needs the death benefit at all. His kids are nearly grown, his mortgage is mostly paid down, and the entire purpose of the insurance, protecting people who depended on his income, has been replaced by an account he built himself. He lets the term policy lapse. He's self-insured now, 14 years ahead of when he originally expected to be, purely because the difference he was investing the whole time finally became larger than what it was protecting against. Stay with this part, because the final checkpoint is the one that actually decides the scoreboard, and it isn't a number on a statement. It's a phone call nobody in this family wants to get. At 52, Dean has a heart attack at his desk on an ordinary Tuesday. He survives, but the cardiac event is serious enough that he can't return to his physically demanding job, and 18 months later, a second fatal one takes him at 53. This is the moment the whole life policy was always built for, and it performs exactly as designed. The $250,000 death benefit pays out to his widow within 3 weeks of the claim. No medical underwriting to fight through, no waiting period, the cash value's loan balance simply subtracted from the total. It's the single cleanest, fastest insurance payout described anywhere in this story, and it arrives at the exact moment his family needs it most. Funeral costs, 11 months of mortgage payments while his widow adjusts her own work schedule, a financial cushion that exists specifically because 30 years earlier, a 25-year-old at a family dinner signed a piece of paper that never once stopped covering him, not for a single month, regardless of what his health did in between. Walt, watching his twin brother's family receive that check, has a hard realization sitting right next to the grief. His own term policy lapsed 7 years earlier. If the same heart condition had happened to him instead of Dean, there would be no $250,000 payout at all, because he made the entirely rational decision to drop coverage once his investment account outgrew the need for it. A decision that was mathematically correct in expectation, and that would have been financially catastrophic in this one specific unlucky outcome. He sits with his brother's widow and does the math out loud, gently, the way only a twin who's been running parallel numbers for 3 decades would think to, even after the loan, even after 30 years of $300 a month premiums that dwarfed his own $42 a month ones in the early years, Dean's family receives $250,000 in a single tax-free check. Walt's own family, in the identical scenario, would have received nothing from an insurance policy, only whatever was sitting in his investment account at the time, which by then is substantial, but arrives with none of the immediacy, none of the certainty, and a tax treatment that isn't nearly as clean. So, which one actually wins? Here's the honest scoreboard. Both halves of it held at once, instead of picked apart for the answer that confirms what you already believed walking in. Across 30 years of ordinary outcomes, no early death, no catastrophic claim, just 2 brothers living out average actuarial lifespans. Walt's term plus invest strategy outperforms Dean's whole life policy by a wide and growing margin, the exact gap the index fund opens up by year 5 and never closes. In the one outcome where someone actually dies early enough for the death benefit to matter, the whole life policy is the only one of the two that pays anything at all, because its protection never expires as long as the premium gets paid, while term protection only protects you for the specific window you bought it for. The real answer, the one neither brother fully had at 25, is that whole life and term were never actually competing for the same job. Term protects a specific window where dependents exist and wealth hasn't been built yet. Whole life protects forever, at a price that only makes sense for a narrow set of people who specifically need permanent coverage. A special needs dependent, an estate tax problem, a business succession plan, and who've already done the math to know it. For almost everyone standing where Dean and Walt stood at 25, young, healthy, with dependents, and without yet enough assets to self-insure, term bought cheap, and the difference invested aggressively, automatically, without exception, wins in the overwhelming majority of outcomes. It just doesn't win in literally all of them, and the one outcome it doesn't win is the one that, however unlikely, you can't get back the chance to insure against once it's already happened. Here's the actual closing math, the one their uncle's binder never modeled, and the one no whole life illustration ever runs for you, because running it honestly would talk most buyers out of the sale. Run the same comparison across 1,000 simulated pairs of twins, same ages, same incomes, same $250,000 benefit, term invested at historical market averages against whole life at its guaranteed crediting rate. In roughly 970 of those 1,000 outcomes, the term and invest twin finishes with dramatically more money, often 3 to 5 times more by year 30. In the remaining 30 or so, almost all of them early deaths inside the policy's term window, the whole life twins family receives a benefit that simply doesn't exist for the term twin once the term has expired or lapsed. That's the real math the entire whole life sales pitch is built on top of. Not a lie about the product's performance, but a sales conversation that talks about the unlikely 30 outcomes as if they were the likely 970. Because the commission on the policy that covers the unlikely outcome happens to be enormously larger than the commission on the one that wins the other 97% of the time. Run your own version of this scoreboard before you sign anything. Ask for the actual term quote alongside the whole life illustration every single time, and make whoever's selling you the permanent policy explain out loud exactly which of those 1,000 outcomes you're actually paying the extra premium to protect against.